Welcome to the Deep Dive, where we cut through the noise and get straight to the essential insights from earnings call transcripts.
Glad to be here.
Today, we're doing a deep dive into Conagra Brands' fourth quarter fiscal 2025 earnings conference call. Imagine trying to steer a massive ship, a consumer packaged goods ship, through a 6-year inflationary storm.
Yeah, that's pretty much Conagra Brands right now.
And we're dissecting their bold maneuver. Sacrificing short-term margin for a long-term bet on volume. Is it genius or is it a huge gamble?
It's definitely a calculated risk. Conagra Brands is navigating what they themselves call a persistent inflationary cycle. Fiscal 2026, that's the 6th straight year of above-average inflation for them.
Wow, 6 years.
Yeah, and this isn't just, a small bump. It's translated into over $2 billion in higher total deliver costs, cumulatively.
$2 billion, that's a staggering figure. And what really jumped out at me from the call was this very deliberate strategic choice they're making.
Prioritizing volume, right?
Exactly. Prioritizing a return to volume growth, especially in their frozen and snack segments. And they know this means temporary margin compression in fiscal 2026, higher investments hitting the bottom line. It feels almost counterintuitive during high inflation, doesn't it?
It absolutely does. And, that's where the real insight is, I think. Management sees this margin compression as non-structural. It's a short-term trade-off.
So not a permanent problem in their eyes.
Not at all. They have really strong expectations for margin expansion starting fiscal 2027 and beyond, particularly in that frozen foods portfolio. It's basically a strategic investment, buying market share, investing in brand health, rather than some fundamental shift in their long-term profit picture.
While other companies might just keep hiking prices.
Exactly. Many peers are still clinging to price increases, maybe milking the brands a bit, but Conagra is making this disciplined bet on getting consumers back and keeping them loyal.
Okay, that makes sense. So this strategic pivot to volume, it's a big bet, but maybe we should back up a bit. How exactly did this whole inflationary mess start for them, and what are the specific cost pressures they're really fighting against right now?
Sure. So the inflation really kicked off in the back half of their fiscal 2021.
Yeah.
And it just hasn't really let up.
It's sticky.
Very sticky. We're looking at another, 11% in combined costs expected just across fiscal 25 and 26. But what's fascinating is the strategy shift. Through fiscal 24, pricing actions pretty much offset the rising costs.
That was the standard playbook.
Right. But then the strategy shifted pretty dramatically in fiscal 25.
Yeah.
Conagra started prioritizing volume growth through, significant investment. They saw the multi-year volume declines happen across the whole industry and decided to fight back.
So instead of just accepting decline, they're investing to reverse it.
Precisely. They believe healthy volumes are just crucial for long-term value creation, for building brand equity. So they chose investment over just more broad-based pricing, which they worried could trigger even more volume loss, trying to rebuild that consumer connection.
Okay, so given this short-term hit to margins, the obvious question is, what's the long-term plan? How do they get profitability back on track? Management laid out a pretty clear roadmap for margin expansion after fiscal 2026. What are the main building blocks there?
Yeah, they did. It really starts with robust productivity. They're actually expecting over 5% in fiscal 2026.
5%. That's substantial.
It is. And that combines their core productivity work with specific tariff mitigation efforts. We're talking factory modernization, more automation, programs like their connected shop floor initiative, things like that.
Okay, so efficiency is key. What else?
Second, they are banking on, or at least anticipating, eventual inflation relief, hoping things get back to a more normal 2% rate eventually. Third, those supply chain resiliency investments they keep talking about.
Yeah, particularly in chicken, right?
Exactly. The chicken plant upgrades, they expect those to let them repatriate outsourced production, bring it back in-house at lower costs. Fourth, they're not completely abandoning pricing. They'll use targeted price increases in specific spots, like canned goods, where it makes sense strategically.
The selective pricing.
Right. And finally, there's this new kind of ambitious initiative, re-engineering core work processes, using technology, even AI they mentioned, to speed up growth and cut costs. They promise more details on that later.
Interesting. AI and CPG processes.
Yeah, and what's really insightful is how these pieces connect. It's not just random cost cutting. It's an ecosystem, right? Factory upgrades, supply chain fixes, smart pricing, new tech, all designed to make that volume-first strategy work financially down the line.
That's a pretty comprehensive plan. Now, that 4% core inflation estimate for fiscal 26, what's actually driving that number within their cost of goods sold? Can we break that down?
Yeah, we can. So that 4% core inflation is based on their total COGS, their cost of goods sold, material costs. They make up about 60% of that total.
60%.
And the single biggest driver there is animal proteins. Think beef, chicken, pork, turkey, eggs. Those are inflating at double-digit rates.
Ouch. Double digits on 60% of your costs.
Exactly. Plus, they're seeing inflation in manufacturing labor and also in transportation and warehousing, though interestingly not specifically in fuel costs this time.
Okay. And on top of that 4% core inflation.
Right, there's an additional 3% impact expected just from tariffs, mostly the tin plate steel tariffs hitting their canned goods business. They do expect to mitigate about 1% of that 3% through, smart sourcing and negotiations, but it's still a significant headwind.
So despite all these investments, these cost pressures, CAG is really emphasizing financial stability. How are they managing cash flow, debt reduction, and keeping the dividend safe through all this?
They were very clear on this. They're absolutely committed to maintaining an attractive dividend. That's priority one. Also paying down debt and keeping their investment-grade credit rating.
Okay, the financial guardrails are still up.
Definitely. Their fiscal 26 cash flow forecast shows a pretty strong 90% conversion rate. Now, interestingly, CAPEX, capital expenditures, are actually set to increase by about 16%.
Increase, even with the margin pressure.
Yeah, primarily because of those infrastructure investments we talked about, especially in the chicken segment. But they're balancing that. They're forecasting a $700 million debt reduction overall.
How are they funding that?
Well, $600 million comes from recent divestitures, getting rid of Chef Boyardee and their fish brands.
Oh.
And then another $100 million comes from discretionary cash flow.
Ah, okay. So divestitures are helping clean up the balance sheet.
Right. So even though EBITDA takes a hit from the investments, they seem really confident in their cash management. They basically said they can walk and chew gum at the same time.
Fair enough. Now, management sounded pretty confident, saying they know how to drive volume growth. They pointed to, 5 consecutive quarters of success before supply issues cropped up?
Yeah, they did make that point.
So how does their volume growth model actually work? What are the mechanics? And maybe crucially, where do their service levels stand right now? Are they fixed?
Okay, so their model is pretty well defined, actually. It starts with modernizing their brands, right? Constant stream of innovation. Then they invest, and they said meaningfully, with their retail customers on high-quality in-store displays. Especially in frozen, those end caps and bunkers apparently drive big lifts.
Making the product visible.
Exactly. Then they layer on A&P advertising and promotion, mostly focused on social media now, to build awareness, create some buzz. And the final piece, which they stressed is crucial, is relying on the product quality itself to drive repeat purchases. Get people to try it, make sure it's good, so they come back.
So innovate, display, advertise, and make sure the product delivers.
That's the formula. And it seems to be getting back on track. Service levels, they rebounded to about 98% in Q4. So supply chain seems much healthier.
98% is pretty good.
Very good. And recent scanner data, the stuff you see from stores, shows volumes are only down about 1%. So they're really close to positive territory again. And their big marketing programs are just starting. Plus, they'll have easier comparisons to lap from last year.
So the trend looks promising.
It does. And those supply chain investments planned for fiscal 26 are specifically meant to solidify this, ensuring they're well positioned for fiscal 27 without repeating past service issues.
Okay, it sounds like their pricing strategy isn't just one size fits all. You mentioned targeted increases. How do they tailor that approach across the different parts of their portfolio, especially with these different goals?
Yeah, exactly right. They use the phrase horses for courses, which I think sums it up perfectly.
Horses for courses. Okay.
So frozen and snacks, that's about 70% of their retail business. So they're considered the growth engines. In those categories, they're intentionally investing margin to drive volume growth.
Yeah.
Using innovation, consumer engagement, all that stuff we just talked about.
Got it. Growth segments get investment. What about the rest?
Well, in stark contrast, you have their canned food business. That's the one getting hit hard by those tin plate steel tariffs we mentioned.
Right.
That business is viewed primarily as a cash generator. So the focus there isn't really pushing for volume. It's about maximizing cash flow, using inflation-justified pricing where possible. And that cash then helps fund the investments in the growth segments, like frozen and snacks.
So canned goods become the cash cow to feed the growth stars.
That's a great way to put it. It's a very pragmatic, very differentiated approach across the portfolio.
Okay, so with an expected operating margin for fiscal 26 landing somewhere between 11 and 11.5%. How does management frame this? Are they nervous about this temporary dip, especially in the context of deleveraging and just long-term company health?
They seem remarkably calm about it, actually. They view these cycles as almost mechanical. First, you get margin compression from inflation hitting you. Then you get recovery through a mix of pricing and productivity gains.
So this is just part of the cycle for that.
That's how they framed it.
Yeah.
And this current investment in volume, they see it as absolutely essential. Essential for long-term shareholder value, essential for brand equity. They're prioritizing that consumer connection over just hitting a specific margin number in the short term.
And what about the factories and supply chain costs during this investment phase?
Yeah, they touched on that too. They acknowledge there's an absorption headwind right now, fiscal 25 and 26, partly because some production gets moved to third parties while they upgrade their own facilities. But they expect that to flip and become a powerful tailwind in fiscal 27 as production comes back in-house at those lower costs.
So the headwind becomes a tailwind later.
Exactly. It's a multi-year plan. And they also mentioned that they're constantly reviewing their manufacturing footprint. If volumes were to decline unexpectedly, they're ready to consolidate the network. So there's an adaptive approach there too.
Speaking of adapting, Conagra has done a lot of portfolio reshaping over the years. What's the latest thinking on M&A? Are more sales or acquisitions likely?
It really has been a massive undertaking. Over the last, 8 or 9 years, they've done a huge amount of reshaping, continuously shifting the focus towards those growth areas, frozen and snacks.
Getting rid of slower moving parts.
Precisely. The recent divestitures, Chef Boyardee, the fish business, that Indian joint venture, those were all seen as non-strategic growth areas. They didn't fit the core focus.
So are they done shedding brands?
Well, they indicated there are other potential exit candidates still within the grocery business, but they stressed any actions will be thoughtful, very deliberate. They recognize that even slower growth businesses play a role. They generate cash, they absorb overhead, and that helps fund the investments in the growth stars.
So methodical, not a fire sale.
Exactly. It's about optimizing the entire business, not just chopping off limbs rashly.
One area where they seem especially focused, almost laser focused, is innovation and making things more premium in the frozen aisle. You mentioned banquet earlier. Has this actually worked? Are consumers paying more? Are they seeing value?
Absolutely. And this is where their strategy really seems to come alive. They were crystal clear. Innovation in frozen is all about premiumization. Higher quality, higher dollar per unit.
Not just innovation for innovation's sake.
No, it has a clear financial goal. That banquet example is perfect. Back in 2015, maybe 90 cents for a meal. Today, same brand, totally different product, closer to $4. But the key insight they shared is that consumers perceive better value because the quality and the quantity have improved so much. It's not just inflation, it's a genuine upgrade.
So value perception is key, even at a higher price point.
Totally. And look at the banquet mega chicken fillets. They designed those to compete directly with fast food fried chicken.
Like a QSR competitor in the freezer aisle.
Exactly. And it apparently blew away expectations, drove a much higher dollar ring per unit. And that success is now leading them to invest more in their fried chicken capacity.
Interesting. So success breeds more investment. What's next in frozen?
They talked about expanding into multi-serve packaging. They see that as a big white space opportunity. And again, the plan is for those offerings to be higher quality, more premium than what's currently out there from incumbents. It really underscores how central innovation is to their whole growth plan.
This earnings call really paints a vivid picture, doesn't it? A major CPG company making a very deliberate choice, trading that short-term margin for long-term volume growth. Feels like they're playing chess while maybe others are playing checkers, focused only on the next quarter.
Precisely. This strategy, it really underscores a long-term view. Thinking about brand health, thinking about market share 5 years from now. They're betting that innovation and making their supply chain resilient will drive profitability down the road.
And it also shows a company juggling multiple priorities, right? Managing debt, keeping the dividend, but still making these pretty significant bets on future growth, especially in frozen and snacks.
Yeah, it's a fascinating case study in strategic foresight and capital allocation, especially in today's inflationary environment.
All right, let's shift gears slightly. Time for our outrageous but plausible trade idea segment. And remember, everyone, this is purely for informational purposes, definitely not financial advice.
Got the disclaimer in.
It's okay. So given Conagra's very explicit horses for courses strategy, investing heavily in frozen and snacks for growth while treating canned foods like a cash cow, here's a thought. What about going long Conagra Brands, maybe looking out towards late fiscal 2026 or early fiscal 2027?
Okay, long Conagra. Where's the other side of the trade?
The other side is simultaneously shorting a basket of, let's say, traditional multi-serve frozen food incumbents, the ones that maybe, as management hinted, have been kind of milking their businesses rather than investing heavily in innovation and quality.
Ah, I see the thesis. So the idea is that CAGRA's aggressive investments sacrificing margin now for innovation, supply chain upgrades, premium products, especially in things like chicken, will give them a real competitive edge.
Exactly. As their new, better quality, multi-serve products hit the shelves, and as bringing production back in-house lowers their costs.
They could potentially grab significant market share and see a much bigger jump in profits and maybe their valuation compared to peers who haven't made those investments or who are stuck in less dynamic categories.
Right. It's basically a bet on CAGRA's strategic foresight, disrupting some of the older, maybe less agile players in that frozen aisle. Outrageous, but plausible.
I'd say that fits the bill. It hinges on their execution, of course, and the market recognizing that shift if it happens.
So that's our deep dive into Conagra Brands' latest earnings call. A company really leaning into a long-term vision, prioritizing volume and brand health through strategic investment, even with all this inflation swirling around.
Yeah, they seem confident, don't they? Yeah. Confident in their path back to margin recovery, driven by productivity, those supply chain improvements, targeted pricing, and that laser focus on high-growth frozen and snacks.
Definitely a company narrative worth watching. Now, as we wrap up this deep dive on Conagra Brands, here's something to think about. If Conagra actually pulls off this strategic pivot, if they successfully trade margin for sustainable volume growth and win share,
Interesting question.
could it force a broader reevaluation in the market? Could it make investors rethink how CPG companies are valued, maybe shifting the focus away from just short-term margin obsession towards long-term brand equity and volume growth as the real drivers of value? What might that mean for how you look at similar companies? Something to mull over.